Good evening, everyone, and welcome back. As you see, the headline for me tonight is building a solid foundation for your trading. And, that will be the back end of my presentation. And really, that's all about what I would feel is a solution to some of the problems that trading brings to us and a way forward to get some longevity into our trading. But prior to that, if I'm going to provide a solution, I want to find out, what am I trying to solve? What are the issues that cause us to, create that platform, that process that we have been talking about over a group of weeks? And, one of the first things that I look at is I feel we're at a time, and certainly inexperienced traders feel trading really is about opening up a screen and then very, very much an instinctive style of trading where they'll watch price action for a short period. They'll want to jump straight in. Maybe they feel momentum is moving to the upside, and that's their modus operandi of trading. And that can work. I'm not decrying that as a trading style, but I think you'll find in the longer term there are some issues with it. One of the other key things is, however much we may disagree, there is a cognitive bias towards buying as opposed to selling as your first trade. I've been on many trading courses where without any information going into the market, the very first price that comes out is paid. There is a buyer in the market. It is a human nature, a tendency, whether we prefer to own something first or feel we need to own something before we can actually take profit and sell it, I don't know. But obviously in financial markets, there's many markets where we can actually short the market first. We can sell before we buy and take advantage of both sides of that market. So, I think that instinctive style sometimes precludes us from some trading options. I think as well, the key thing for me is instinctive trading is great while things are going well. But the problem is as things start to turn against us, the instincts disappear and our emotions begin to take over. And as I've mentioned on many an occasion, emotions can destroy our trading. When they get heightened, we start making rash decisions. And, that whole idea of that solution, that trading platform that we're talking about, is the solution to these emotions. We try and let the method dictate our emotions. So a couple of reasons there why I feel trying to build this foundation is good for us. Very quickly, I also want to look at some of the key mistakes that we do make. And you'll see here, I've broken them into psychological and trading. They do actually cross over in terms of some of the errors that come through in our trading. But the reason I've got it here is this psychological side is so important, and it proves that lots and lots of our mistakes are driven by our psyche. Theory tells us 80% of our decision making is driven by our emotions, whether it be fear, whether it be anger, whether it be overconfidence. All those kind of things, they take over when markets start moving fast. And, I've got a few there. This fear of making a loss. As I've mentioned there, the instincts go out the window and we forget and we don't know how to take profit because we're frightened. To take a loss because we're frightened of making that loss. We know the hit to our bottom line and we just don't want to take it. And that's obviously very critical when we talk about capital preservation. We've also talked about the fear of missing out, FOMO. That's the situation where we just jump on trades unnecessarily because everybody else is on it. Well, if everybody else is on it, for me, that's a signal not to get on it. That tells me the price is already elevated because lots of people have got on that trade already. So I'd be very careful about jumping on these. And again, it's an emotional response, a bit of peer pressure in some respects. We also have a fear of leaving money on the table. This precludes us from taking profit where maybe we should, because we're always worried that if I sell here, what if it goes higher? Well, my answer to that is, so what? I've made my profit. I can be looking for my next trade. I could even buy again, but I should be happy to take profit when I feel it's necessary. From that trading side, we got a bit of a linkage there as well. We do actually take profits way too early. I know that's contrary to what I've just said, but there is a trait where we take profits way too early and we run our losses way too far. It's a combination of all those things I've spoken about, but that is a very, very dangerous negative risk reward scenario. And if we continue down that vein of trading, we will end up losing most of our capital. We also chase markets, trying to recover losses when actually, when I talk about the process, the big process there should be actually stepping away. We need a process to rely on when things go wrong. And instead of us jumping in and trying to recover all our money at the same time, we rely on that process. So hopefully you already start seeing why we talk about, building this foundation. It's a method to how we go about things. And, that's something that hopefully you'll see over the next few slides can help some of these psychological issues. Another quote I've got there from Seth Klarman, CEO of Baupost, very, very large hedge fund. Ultimately, nothing should be more important to traders than the ability to sleep soundly at night. I firmly believe that if we have this process, if we are doing things for a reason, yes, we want to keep some instinct, but we need something to fall back on all the time. And that's what will help us sleep at night as well. So what is this foundation? Well, we've shown you this process wheel before. And these are the elements that really, as we go around and we formulate our trade, as we go into execution, we're always relying on doing things in a very, very processed and formulaic manner, not to the point where it's very, very arduous task, but it's something that we can fall back on. When things start going wrong, we need something to fall back on and say, why did I make that decision? Was that the wrong decision, or was it still the right decision? I just got a bit unlucky. So this is a good reason. You often talk about elite athletes. I often talk about golf. They have a bad round and the commentator says, so what are you going to do? That was a tough round. I'm just going to go back to that practice ground. I'm going to trust in my process. I'm going to create this disciplined trading process here so that we can actually, after our trading, go back, take a look at it and see what we did right, what we did wrong, and move on from there. So very quickly around each of these categories, we've got your read and research. These are the inputs, everything coming in, all the drivers of the fundamentals, the macros of the market that we should understand. These are the things that make the market tick. Within there, there's also market price action. That should show you some current sentiment. You'll also get that from your charts. And it's an ongoing thing. So, we need to keep our finger on the pulse. There's no good having a trade idea, formulating it from, all of these inputs, and then we leave it for a week and we don't read up on what's happening because those drivers will change. So it's very, very important we keep our fingers on the pulse there. But ultimately, the output from all of this reading and research will be our trade ideas. And then we move to putting that into action. How do we put that into the market? For me, the most important thing of this whole process, Will, is this piece, the assignation of risk. Far too many people will just put the same amount of risk onto every single trade. And that simply cannot be right, because there will be trades where you just simply haven't done your homework. There will be trades where you just simply won't have the same level of confidence as in others. There will be markets where conditions are very, very tricky. There will be periods where you've had a poor run of trading. And in all these instances, we should be adjusting our risk levels accordingly so that we are comfortable with the amount of risk we're putting into the market per trade, and that it is equal to the levels of confidence, market conditions, and where we sit in terms of our trading history and our capital levels. And so that arrow there should be moving from the left to right. Think of this as a bit of a visual so that each time you go to put risk on, say to yourself, have I got the right levels of risk for this trade idea that I want to put in. One important thing I've put there as well, this is not a competition. Every individual has his own mental capacity to handle risk. When the numbers get bigger, some people just can't cope. That doesn't mean to say they're a bad trader. It just means they've gone past their sweet spot. So work hard to try and find where that sweet spot is for you in terms of risk, and make sure the numbers work for you so that you don't start panicking when they get slightly bigger. The order management execution piece, this is simply where we get in, where we get out. What type of strategy do we use? There are many, many strategies. We don't always have to be one-dimensional, in and out in the same levels. We can wait. We can be a bit more patient and wait for the market to come to us on a dip if we want to buy. All those kind of things, different strategies. But the key thing is we need to plan this trade. Look at those charts, find out where the key levels are, and have a good idea where you're going to plan that trade, and then execute that plan. Trade that plan as to how you see it. Key thing there, set your stop loss. Where is the important level that if my trade idea goes wrong, if new news comes into the market and it goes against me, where am I out? Where should I be out? Where does the market tell me I'm completely wrong? Don't wait. Just get yourself out at the correct level. If that correct level, relative to the size of your position, is not affordable, you do not move your stop loss closer to your entry position. You reduce the amount of risk so that your stop loss is always at the correct level and it's affordable to you. And then you go about looking at where you're going to take profit. Choose an area and not a specific level. And make sure it's realistic. Looking at something, if you're quite often having a stop loss of 20, 30 points away, there's no point looking at a take profit 500 points away. Make sure it's realistic to your style of trading and the market that you're in as well. And very crucial, only deviate when new information comes into the market. Quite often from a chart perspective, you'll hear, if the trend continues, if there's no new input to tell you that the trend may have changed, then you don't have to change your position. You just maybe change your levels and move your levels a little bit higher, because the information is nothing that's going to stop you from playing that trade. And then the final piece that I have here, very, very critical, is evaluation. I often say this is not a post-mortem. It's not there for you to beat yourself up if you've had a tough time. It's there for an honest assessment to look and see that you were disciplined in what you did. You went around this process well. Your trade ideas were good. You're still reading the market well. Maybe you just got a bit unlucky around your levels. So then maybe look at those charts to see whether you're reading those levels right. Did you place your orders at the right levels? These are important things to do. As I say, don't beat yourself up. What we're looking to do is find out what we did well, make sure we repeat that. And as we work through the evaluation, if there were some things we did, maybe we did lack a bit of discipline. Maybe we did move that stop loss 50 points lower because we had a fear of taking a loss, and we eventually still took that loss anyway. We should read that as a mistake. Emotions took over there. Our process was to take out our stop at that level. Don't move it, and certainly don't move it because of emotional reasons. Now, we can go a lot further. There are trading metrics we can look at in more depth, statistical analysis. I would suggest we look at that in a different webinar. And maybe from a big picture perspective, we can do a session on trading goals. What are we setting out to achieve from this? And, in some respects, where does that sit within our life? Is this just a hobby? And if so, make sure we're only trading it from a time perspective as a hobby. Make sure it's not impacting on the more important things in your life around family, work, etc. So, some big picture things that we can think about there. But this whole evaluation process and then working towards some of these trading goals that we can set ourselves should put us in a good stance to continue and add longevity to our trading.